A statement balance and a current balance can appear on the same fictional card account and still answer different questions. In this example, the statement balance is $640 at the September 3rd close, while the current balance is $725 on September 6th. The first number is a dated snapshot. The second is a later view that can keep changing as posted activity arrives. A gap between them does not automatically mean one number is wrong. It may simply reveal two different cutoff times. Imagine Elena using a fictional card account for ordinary classroom examples. Nothing here describes a real issuer or contract. In this invented cycle, the account opens, purchases post, the statement closes on September 3rd, and the payment due date is September 24th. The circular cycle scene gives those events an order without treating the close date and due date as the same event. At the September 3rd close, a fictional statement page records $420 carried into the cycle and $220 of posted cycle purchases. Those two displayed lines total a $640 statement balance. The page is a frozen close date document. It describes what the fictional account included at that specific cutoff. 3 days later, on September 6th, Elena makes a fictional $85 bookstore purchase. Assume it posts immediately for the purposes of this lesson. The post-close scene keeps the September 3rd statement closed while the $85 receipt moves into the new cycle. Later activity can change the live account view without rewriting an already produced statement. The layered balance scene shows the arithmetic. The first layer is the $640 statement balance. The second layer is $85 of post-close activity. Together they make a $725 current balance on September 6th in this deliberately simplified example. The equation is $640 plus $85 equals $725. That makes the two balances easy to compare. Statement balance means $640 at the September 3rd cutoff. Current balance means $725 at the September 6th cutoff. They refer to one fictional account, but they are not measurements from the same instant. The $85 difference is explained by the later posted bookstore purchase. The due date bridge adds a separate time relationship. September 3rd is the statement close. September 24th is the fictional payment due date, creating a 21-day interval in this example. The bridge does not claim that every issuer uses 21 days. It only makes the two displayed dates and their order visible. Now suppose a $640 payment posts before the fictional due date. With no fees, interest, credits, returns, other purchases, or other payments in this simplified sequence, that payment matches the $640 statement balance. Because the $85 bookstore purchase belongs to later activity, the current balance would then display $85 after the payment posts. This result depends on the stated assumptions. A real current balance can move for many reasons, and payment posting can take time. New purchases, refunds, fees, interest, adjustments, or a payment that is still processing can change the live number. The scene says assuming no other changes because the arithmetic is not a universal promise about every account. The billing cycle continues after the September 3rd close. Activity that misses one cutoff can be captured by a later statement close instead. That is why a current balance is not simply a corrected statement balance. It is a moving account view, while the prior statement remains a dated record. The fictional $85 purchase therefore stays outside the September 3rd statement even though it appears in the September 6th current balance. The relation is about timing, not about hiding a purchase. One document closes, the live account continues receiving posted entries. Two magnifying views make the distinction compact. One lens reads statement balance, $640 at September 3rd. The other reads current balance, $725 at September 6th. The labels and dates carry the meaning. Comparing the numbers without their cutoffs would remove the reason for the gap. The statement snapshot also preserves its internal arithmetic. $420 plus $220 equals $640 at close. It does not include the later $85 purchase, so adding that purchase directly onto the old page would change the historical snapshot rather than explain the live account. The close date and due date also serve different jobs. The close date decides which posted activity appears in that statement snapshot. The due date is the later payment deadline stated by the fictional terms. A due date does not move a post-close purchase backward into the earlier statement. Likewise, the current balance layer can include activity that the statement layer does not. In this example, current equals statement plus the new cycle purchase before the payment posts. That visible stack supports the $725 figure without implying that every real current balance always has only two components. After the fictional $640 payment posts, the payment match scene leaves $85 as current balance under the no other changes assumption. The display is a reconciliation of this one sequence, not a recommendation about how much anyone should pay and not a claim about interest, minimum payments, or grace periods. A four-field scanner finishes the reading method: close date, statement balance, due date, and current balance. Each field answers a separate question. Keeping the labels attached to their dates prevents a live balance, a dated snapshot, and a payment deadline from becoming one vague number. The core lesson is simple: a statement balance is fixed by a past cutoff, while a current balance can include later posted activity. Dates explain the difference before arithmetic does. Terms, posting rules, and account displays vary, so real statements must be read according to their own definitions. This content is educational only, not financial advice.